Losing your job, your house, your entire life savings in a single afternoon. That sounds like a nightmare, right? No, the 2008 financial crisis might just be one of the biggest economic disasters ever. But one thing always confused me. How did it happen so fast? I mean, how could the entire global economy just collapse overnight, and why did it feel like nobody saw it coming? So let's tackle that question. In this video, we're going to explore just what happened during the great financial crisis of 2008. So buckle in, it's going to be an interesting one. So before we go into the details, there are a couple of basic facts that we should be using in this video. The crisis was rooted in the US housing market, but it spread globally through complex financial products. By the way, financial experts are supposed to be so smart and cautious. So the choice of betting the entire economy on risky mortgages always escaped me. But I digress. The key terms to know are subprime mortgage, mortgage-backed security, and credit default swap. So the more of these you understand, the clearer the whole mess becomes. Okay, let's get started with the root of the problem. Fans of recent history will know that before the crash, there was a massive housing boom. So how big was this boom? The years leading up to 2008 felt like a gold rush, but instead of gold, it was houses. From about 1997 to 2006, the average home price in the United States more than doubled. Think about that. A house you bought for $200,000 was suddenly worth $400,000 or more in less than a decade. It felt like free money. People were using their homes like ATMs, taking out equity to buy cars, go on vacations, or even invest in more property. This frenzy was fueled by incredibly low interest rates set by the Federal Reserve, which made borrowing money cheaper than ever. Lenders were practically throwing money at people. Mortgage approval rates went through the roof, peaking at a point where it seemed like almost anyone who applied for a loan got one, regardless of their financial situation. This created a self-fulfilling prophecy. Easy credit meant more buyers meant higher prices, and higher prices made everyone feel richer, encouraging them to borrow even more. The market was a bubble, stretched to its absolute limit, and everyone was convinced it would never pop. So, how did so many people get loans they couldn't afford? This brings us to the subprime explosion. The term subprime sounds complicated, but it's actually pretty simple. It refers to borrowers who are considered high risk. These are people with low credit scores, unstable income, or a history of not paying their bills on time. In a normal, healthy market, banks are very careful about lending to these individuals. But during the housing boom, that caution went out the window. Lenders started offering what were called ninja loans, which stood for no income, no job, or assets. You literally didn't have to prove you could pay the money back. Imagine walking into a bank as a part-time freelance dog walker, with a spotty credit history, and walking out with a $500,000 mortgage for a house you could possibly afford. That was happening all over the country. These loans often came with a catch, a low, attractive teaser interest rate for the first couple of years. But after that initial period, the rate would suddenly adjust to a much higher variable rate. A family that was barely making their $1,500 monthly payment would suddenly see it jump to $3,000. As interest rates started to rise in 2006 and 2007, millions of these subprime borrowers found themselves unable to pay. The default rates skyrocketed. At the peak of the crisis, more than 15% of all subprime mortgages were in foreclosure. Neighborhoods were filled with for sale signs and abandoned homes. The foundation of the entire housing market wasn't just cracked, it was crumbling into dust. The very loans that had fueled the boom were now the dynamite that would blow it all up. Now, you might be thinking, okay, so a bunch of risky loans went bad. Why did that take down the entire global financial system? That's where we get to the bank domino effect. The banks didn't just hold on to these risky mortgages. They bundled thousands of them together, subprime and prime alike, into complex financial products called mortgage-backed securities, or MBS. They then sold these bundles to investors, hedge funds, and other banks all around the world. It was like making a giant financial sausage. You didn't know exactly what was inside, but it was stamped with a AAA rating from credit agencies, the highest possible rating, suggesting it was as safe as government bonds. So, when homeowners started defaulting, these securities, which were owned by financial institutions everywhere, started to become worthless. They were toxic assets. The first major domino to fall was Bear Stearns, a major investment bank, which was sold for pennies on the dollar to JP Chase in March 2008 to prevent a total collapse. But the real earthquake hit on September 15, 2008. Lehman Brothers, an investment bank with over $600 billion in assets, filed for the largest bankruptcy in U.S. history. The government decided not to save it, hoping to teach the market a lesson. Instead, it triggered a full-blown panic. Credit markets froze. Banks stopped lending to each other because they had no idea who was holding the toxic mortgage debt. The very next day, the government had to step in to bail out AIG, a massive insurance company that had insured trillions of dollars worth of these toxic assets. Merrill Lynch was forced into a sale to Bank of America, and Washington Mutual, one of the largest savings and loan associations, collapsed entirely. It was a cascade of failure, each one bigger than the last, and it all happened in a matter of days. With the entire financial system on the brink of apocalypse, the US government decided it had no choice but to intervene. This led to the creation of the Troubled Asset Relief Program, or TARP. The government essentially passed a massive rescue bill to buy up the toxic assets and inject capital directly into the banks to keep them from failing. The total initial amount authorized for this bailout was a staggering $700 billion. To put that number in perspective, the entire annual discretionary budget for the US government at the time was around $1 trillion. This bailout was equivalent to about 70% of all the money the government spent on defense, education, transportation, and everything else for an entire year. It was an unprecedented and hugely controversial move. Many Americans were furious that their tax dollars were being used to bail out the very banks that had caused the crisis through their reckless behavior. The debate over too big to fail began, questioning whether some corporations are so important that the government has no choice but to save them, no matter the cost. The fallout from the American housing market didn't stay in America, because those toxic mortgage-backed securities had been sold all over the world. The crisis went global almost instantly. Banks in Europe and Asia that had bought these assets suddenly found themselves with massive losses. Credit dried up everywhere, leading to a severe global recession. The result was a devastating wave of job losses that swept across the planet. An economist at the International Labor Organization, Raymond Torres, actually managed to calculate the worldwide impact. He figured out that between 2007 and 2010, global unemployment spiked by over 30 million people. The worldwide unemployment rate jumped from 5.6% to 6.6% in just 2 years. In the United States alone, 8.7 million jobs were lost. To compare, during the worst years of the Great Depression in the 1930s, the unemployment rate in the US hit about 25%. While the 2008 crisis didn't reach that level, peaking around 10% in the US, it represented the most severe economic downturn the world had seen since that time. It was a stark reminder of how interconnected our modern global economy is, where a housing problem in Phoenix, Arizona, can lead to a factory worker losing their job in Guangzhou, China. The Great Recession, as it came to be known, left a deep and lasting scar on a whole generation.